Hi, my name is Ted Daley, and this is my optimization final project report for MEMS 5001. So my project is to maximize the expected return of a portfolio that's composed only of the stocks from the Dow 30 index, given the maximum weight for any one stock, the maximum risk level or variance of the total portfolio, and the weights must be non-negative, so there's no shorting of any stocks. The first thing I had to do is calculate the expected return for each stock, or E of R. To do this, I used the capital asset pricing model, or CAPM, which is a commonly used asset pricing model. The formula is listed below. RF is the risk-free rate. In this model, I used the interest rate on a 3-month U.S. Treasury bill, which is normally used as a very safe but low yield investment. RM is the expected return of the market. In this model, since I am only using stocks from the Dow 30 index, I use the S&P 500 as the market to avoid crossover. Beta reflects how risky an asset is compared to the overall market risk, and I'll show how I calculate that on the next slide. So basically, beta is a ratio of how risky a stock is compared to the market. So this is the most difficult part of calculating the expected return. I had to get closing price data for each stock and the S&P for the last 3 years, and I got that from Kaggle, which is a data collection website. The percent change in the closing price from the previous day reflects the return of the stock on that particular day. So beta equals the covariance of the stock's daily change and the market's daily change divided by the variance of the market's daily change. And some sample calculations are shown on the right. To calculate risk, I had to create the covariance matrix, which is the covariance of each stock with each other stock, as well as the covariance with itself, which is just known as the stock's variance. And the total portfolio risk is the sum of the covariance of two assets times the weight of each of those assets. And that created a nonlinear constraint in my MATLAB code. And the constraint is the risk minus the risk max, which is an input, has to be less than 0. So for my MATLAB code, I used the fmincon function with 30 design variables, which are the weights for each function. The lower bound of each stock was 0, so that there's no negative weights, and the upper bound was the maximum weight set in the function, and you can see the function to the right. The outputs were the weights vector, which are W, and the expected return of the portfolio, which is port value, and that's going to be a percentage of expected return of how much money you put into it. Here are some sample results to the right. As you can see, they change based on the maximum weight and the maximum variance, which are the input variables. Some things I noticed were JP Morgan and Microsoft were pretty much always at the maximum weight available, and many stocks were not worth buying. It is important to note that if I used a different time period, for example 1 year versus 3 years, these weights would probably be different. To improve this model, I could use a web scraper because I use historical data up to the 31st of December, but I could make it more up to date. And there's probably a way to not have to go back and forth between Excel and MATLAB, but that's probably past my coding knowledge. The end.